Want to know 5 hacks when it comes to running real estate comps and determining your ARV so you can wholesale deals faster and easier? Hey, it's Ryan Zomorodi, and at Real Estate Skills, we help everyday people build 6- and 7-figure real estate investing businesses through our coaching, training, and closing deals with our students. Today, I'm covering 5 questions for my coaching clients that we discussed this past week on our live mastermind coaching calls. My producer, Tim, is going to ask some questions that he thinks will add the most value, and I'll be answering them here in this video to help you close more deals and make more money. Let's dive in. Tim, what's the first question?
Question number 1, how do I calculate ARV with inconsistent comps?
This is a very common question and something that every investor, every wholesaler will run into at some point in their investing career. The first thing, you just want to understand, what are you running comps for? If you're going to run comps for fix and flip, you need to make sure that you're looking for comps that are in the best possible condition. You don't want to run comps for distressed properties. You want to understand what the finished product is going to be at the end of the whole life cycle of the deal. So for example, if you're fixing and flipping a property, you need to find the most renovated comps that have been fully remodeled. Ideally, you want to look for flip comps. So you can tell a lot of the times, if you look at the price history of a particular comp, you can see that it was recently purchased for less than it sold shortly thereafter. So a lot of times you'll see a property that was bought for a certain price, and then 5-6 months later, it's relisted for significantly more. Plus, you can tell that the renovations are immaculate. The floors are done, the paint's done, the kitchen's brand new, baths are brand new. So those are the types of comps you want to be looking for first and foremost. So if you can't find those, typically you want to expand your criteria slowly but steadily. So typically we look for those comps within a 1/4 mile radius or up to a 1/2 mile radius from the subject property. If you can't find that, then you may expand it up to a mile, but just keep in mind, you want to make sure it's within the same neighborhood. You also want to make sure you're matching property type. So you want to compare, 3-bed, 2 baths to other 3-bed, 2 baths, and you don't want the square footage to go over, let's say, plus or minus 20% of the subject property. If you're still not able to find good comps after expanding your criteria, then you just want to use more of a price per square foot model. This is where I think a lot of people kind of miss the mark, is that you have to understand that properties have value in a certain market, right? If you're not seeing renovated comps, you still have to understand what prices are people paying for properties in that market. So if you can kind of sort in a market by what's the highest value per square foot that a similar property is selling for, right? You still need to kind of compare apples to apples. So you don't want to be looking at a 4-plex as your comp if you're trying to comp a single family property. So you want to compare like to like and just see what's the ceiling of value for a certain type of asset in the market. Okay, and that kind of establishes your ceiling. So from there, you can get a range of what's the highest price per square foot and what's the lowest. And based on that, start with the highest and see what's more comparable to the subject property, right? What features are more comparable? You have to kind of adjust for the features. So if your subject property has a pool, but the other highest selling property does not, then you could probably estimate that yours can sell for a little bit more if yours has a pool. Same with a view, right? If the highest selling property has a nice view of the ocean or some mountains and yours does not, then you have to realize you have to adjust downward for your subject property. You can come up with a pretty conservative, reasonable estimate of what the value is based on the price per square foot of competing properties, then multiply your property square footage by that number. So basically, you want to filter as hard as you can to find the most relevant comps to what the end product is going to look like. You want to weigh the most relevant comps heavily towards what your ultimate value is going to be. Look at their price per square foot. Choose the most relevant 3 to 5 comps, even if they're not identical to your property, and then come up with a conservative value based on the price per square foot, adjust for features, and then you should be able to get to a point where you can comfortably and competently justify any sort of ARV that you're coming up with based on the real data. We can't just make up values based on what we think it could sell for. We never want to break the comps. So use the data and then let the data tell you what to do and ultimately help with your ARV. I can go into a lot more detail about how to run comps. We do have a pretty detailed resource that we can share with anyone who's interested in kind of learning our criteria for running comps. It's called the Real Estate Skills Comp Criteria Cheat Sheet. Tim, where can they get that?
It'll be realestateskills.com/comp.
So yeah, if you want to get our comp criteria cheat sheet, this is what we use to analyze any fix and flip deal, running comps on any property around the country. Go to realestateskills.com/comps to get our cheat sheet. What's the next question, Tim?
What are the best tools for running comps if I don't have access to the MLS?
Great question. And most of the deals that we're doing are from the MLS. I'm a licensed agent in California. I have access to the MLS. I consider that direct MLS access, but I'm also buying deals on the market in other states, right? I've done deals in over a dozen states at this point. So how do I access the MLS in other markets? So I'll use Redfin as my number one site. I've said this before, it's my favorite site on the internet because you can get access to deals really in any market just by going online, looking at Redfin. Redfin pretty much mirrors the MLS in most markets, and it's up to date so that when a property gets listed on the local MLS, it goes out to Redfin within a matter of minutes a lot of the time. If you don't have direct MLS access in a market, go to Redfin and you're going to be able to find and filter out properties, whether you're looking for a distressed piece of real estate, if you want to buy a rental property, or even if you're just looking for your primary residence. So Redfin's my number one site. There's also Zillow. I think everybody knows Zillow. It just depends on knowing how to use it. So it's also about the filters, understanding what you're ultimately looking for. But Zillow has a lot of great features and filters that you can find properties, whether you're looking for a single family house, multifamily property, land. They also have pretty robust rental marketplace. So you can advertise your properties for rent. You can see what's available for rent as well. This also helps when you're running comps and trying to see what a property can rent for. Zillow is probably my second go-to site. Both Redfin and Zillow are free. There's also realtor.com, homes.com. I use those less just because I don't prefer their user interface as much, but those are kind of the same concept as Redfin, Zillow. You get access to the MLS, but you don't necessarily need MLS access to look at all the inventory. The main difference between direct MLS access and using the free third-party listing websites is that on the MLS, you get access to agent confidential remarks. So sometimes you can get really important information from these remarks, such as we're accepting offers until Wednesday, or hey, we're in a multiple counter scenario, submit your highest and best, or showings are only at this time and date. So sometimes you get behind the scenes information in the MLS, which is why it's so important to get direct MLS access. And furthermore, if you're in a non-disclosure state, meaning the sold prices of properties are only available in the MLS, they're not required to become public information, then you're going to need MLS access, or else you're not going to be able to find the sold prices of properties in your market, which is obviously extremely important when you're running comps and determining your ARV. So that kind of brings in the next solution if you don't have MLS access. What we recommend is getting Privy. So Privy is a software that has essentially licensed information from individual MLSs around the country. Now, Privy's not in every market, but they're in a lot of different markets. If you go to their website, you can see the entire coverage of where they actually do have MLS access. I have used Privy. It's great for certain things. They have filters where you can find properties, you can find flip comps, which I think is really nice. It'll show you which properties have been flipped. It shows you the before and after, how much was the price increased, what was the percentage of value that was increased, and it can help you find buyers of different properties, right, if you're looking for cash buyers. So Privy has a lot of very interesting filters, but the most important thing and the most relevant situation why I would recommend Privy is if you're in a non-disclosure state. If you're in Texas, for example, if you hop on the public-facing listing sites, you're not going to be able to find the sold property information, the price more particularly. So if you go to Privy, you can see that price and you can just simply pay for access to Privy. So every other software I mentioned is free except for Privy. They do charge, I think it's like, $100 a month or $150 a month. It's worth it if you're serious about doing deals in a non-disclosure state and you do not yet have MLS access. In that situation, I would recommend Privy above the other websites. But you do have to pay for it. Fortunately, we have a good relationship with Privy, Real Estate Skills being the leading educator of pursuing on-market deals. The folks over at Privy have been really generous. They've given our audience a discount. So we'll leave it in the description of this video. So if you are considering Privy as an alternative to direct MLS access, you definitely want to take advantage of the discount that we're able to provide through Privy to our audience. So check it out in the description. Between Redfin, Zillow, Realtor, Homes.com, if you're looking for income properties, go to LoopNet.com. And then of course, Privy, you can certainly get all the information you need between those websites. And now that I think about it, I also use Google Maps a lot when I'm running comps. And this is obviously a free website. I think everybody at this point knows Google Maps. But what you can also do on Google Maps is look at the street view. So I like to walk the neighborhoods whenever I'm running comps and look at do a virtual walkthrough of the neighborhood. This allows you to see what the curb appeal of the property is, what the neighbors look like. Sometimes if it's on a street, I like to kind of walk the street and look at the speed limit, because if your house is on a 45-mile-per-hour street, you know that that's going to be a negative because you have cars zooming by and it's going to be difficult for people to go in and out of the driveway. And that does impact market value. Definitely use Google Street View when you're running comps too. I like to see exactly how far apart our comps are. So I'll have the subject property and then I'll list all the comps that I'm looking at just to see exactly how far they are and really just get that aerial view, which is so much more detailed than the maps that you'll see on any of these other websites. So Google Maps, definitely honorable mention. Of course, it doesn't have comps on Google Maps, but when you plug in the addresses, you can really walk the neighborhood, and it's just pretty phenomenal what we have access to in today's age as being real estate investors. Thank Google for having this whole ecosystem where we can literally walk streets and pretty real time within the past year or so is when they update these maps. So it's pretty fantastic, and I use it for every deal that I'm running and looking for the ARV on. So all in all, the MLS is fantastic, and I highly recommend getting access to it in the markets that you're active in, but don't let not having MLS access deter you from becoming an investor, for pursuing deals, because amongst the websites that I recommended, using real estate agents in markets to help you run comps and really just pull the data for you, there's really no excuse to not pursuing any business model in real estate because you don't have direct MLS access. Just know that myself, a lot of our students, they are doing deals just on Redfin, just on some of the websites I mentioned, and so can you. All right, Tim, so what's the next question?
How do I know which comps are relevant?
So how do we know which comps are relevant? What are you analyzing for? What's the end game with this property? What's the business model that you're going to implement for a deal? If you're looking at as a fix and flip, you're going to want to find comps that have also been flipped. You want to find the comps that are similar, which I'll get to in a second, that have also been renovated. If your plan is to buy, fix, and sell, you ideally want to find similar properties that have been bought, fixed, and sold, or just have been fixed up and really represent the top of the market for that type of property. So condition is really important when it comes to analyzing comps and making sure they're relevant. If you're looking for an as-is comp, for example, so sometimes you just want to determine what the as-is value is. So you might want to do an appraisal just to make sure you're getting a good deal on what the current property value is. Then the condition should reflect whatever your subject property is in right now. So if you're buying a distressed house, look at other distressed houses that have sold recently in the area that are similar to yours and kind of determine what other buyers are willing to pay, what have they actually paid. And if your price is significantly over that, then that might tell you that you're overpaying for this particular deal. First off, it's condition. What's the outcome? What's the end game? What are you trying to appraise the property for? So it's, ARV is after repair value. So that's after improvements have been made. If you're doing an as-is appraisal, then you just want to find something in its as-is condition. It might be distressed, it might just be outdated. So find the comps that really represent what kind of valuation you're actually shooting for. The next is location is so important. That's the one thing that you cannot change on a property is the location. Ideally, the closer the proximity is to your subject property, the higher weight I like to give that comp, right? A comp on the same street is going to be worth a lot more to me than a comp half a mile away. Proximity is super important. You want to make sure you're definitely in the same neighborhood if you can't find comps that are on the same street or a neighboring street. And then once you have the proximity dialed in, you want to keep it within like half a mile. Once you have that dialed in, then you want to look at the bed bath count. So if you have a single family house and it's a 4-1, for example, kind of a funky floor plan. If it's a 4-bed, 1-bath, you don't really want to compare it to 4-bed, 3-baths, because that's going to be so much more attractive when you have 3 bathrooms compared to 1, especially when you have 4 bedrooms and you have 1 bath. Those are much harder to sell. And I flipped houses with 4 beds, 1 bath, and it takes a lot longer to sell. There's a lot less buyers who are interested in that. So unless your business plan is to add bathrooms to make it like the comps that have more baths, then just make sure you're comparing apples to apples, because that will attract different buyers at the end of the day. Keep that in mind. You want the bed bath count to be as similar as possible. And if there aren't comps that match the bed bath count, then you simply just have to make adjustments. And so as you start to look at sales in your area, you understand values, and you can really understand how much a bathroom will add or detract value from a certain comp. Bed bath count is super important. Size of the property is very important too. So there's lot size and there's actual living area. So square footage, you want to keep it within about, plus or minus 20% of the subject property square footage. You want to also make sure the lot size is comparable. This is more important in certain markets where land is scarce and you don't have abundant land, and especially developable land in the area. For example, in some areas in Southern California, land is extremely scarce. So if you have a big lot, that's going to sell for a premium compared to the exact same house on a much smaller lot. Whereas other markets, right, where there's a lot of land, bigger properties, especially rural areas, you might go up and down an acre and it's not going to really impact the value a whole lot. Size of the home is super important, right? Bed bath count. School district is also pretty important, especially if you are going to be reselling the property. You might have a very comparable property, but on one street you're in one school district and a couple streets over you're in a different school district. These are things that you can easily find online. Zillow, for example, they usually tell you what school district you're in. So you can do a little bit of extra research just to make sure you're truly comparing one property that's going to be just as attractive as the other. And additionally, what's very important is how recently was the comp sold. If it's older than a year, it's not that relevant, unfortunately. There are special occasions where if there's absolutely no comps, you can go back a year, maybe even 2 years, but that's very rare. Because if you think about it, even a property that's just 6 months old at the time that you're running your comps, by the time you close on the property, renovate the property, and bring it back to market, that 6-month-old comp might be 12 months old by the time you bring it back to market. And an appraiser is probably not going to use that comp unless they absolutely have to. The more recent the comp has sold, the more weight you should put on that comp, because that's really more representative of where the market is today versus 12 months ago, 24 months ago, because markets are dynamic, inventory fluctuates, interest rates change. There's a lot of different things that can happen within, 12 to 24 month period that can impact values. The more recent the comp, the more weight you should put on it. And remember, this just takes time. This takes experience, knowing your market. So the better you are at running comps and really just determining what's the end game, what am I really comping for, that's going to make you more confident in your numbers and make you a better real estate investor, wholesaler, or whatever your plan is. It's just going to make you that much sharper in real estate. Well, that was a great question. Hopefully that was helpful. Tim, what do we got next?
Should I use a comp from across a major street?
Should I use a comp across a major street? This has burned a lot of new wholesalers, new investors, when you use a comp that is on a busy street, because if you have a street that's 45 miles an hour, that's going to create noise for the homeowners. That's going to create inconveniences of going in and out of a property. You just want to make sure that whatever comp you're using has the same curb appeal and it has the same street feel as the subject property that you're using. So what can happen when you cross a busy street or like a major intersection is that neighborhoods can change drastically. There are some markets where values can change from block to block. I've been wholesaling, I've been flipping in Chicago, for example. That's a very block by block area. So sometimes you might be in one neighborhood where values are 20% higher for the exact same properties. Not even half a mile away, you can have other properties that are very similar that will be selling for significantly less. So real estate at the end of the day is hyper local. What that means is every street is different when it comes to certain neighborhoods. So I own properties in an area where every single block away from the university gets less and less desirable and less value because the proximity to certain amenities create a premium in price. You just really have to understand the area, like when you have a major dividing street, which is kind of what I assume the question's about. Sometimes zoning can also change. For example, you might have commercial properties on one side, you might have industrial on the other, and you might have some residential mixed in. So You just have to do as best you can to compare like to like, because your values can be skewed significantly if you're not comparing the right properties to each other. So let's say you have a subject property in a quiet residential cul-de-sac and you're using a comp that is the exact same model match house, but it's on a busy street. So a lot of times I'm asked, like, what's the discount that you should make on the property that's on the busy street? My preference is just to not use that at all. Don't use that comp on the busy street unless you absolutely have to. I would say anywhere from 10 to 20% is really that discount that you should make. So it really just kind of depends on market conditions, days on market in the area, inventory levels. Those can kind of create a supply and demand dynamic that can skew values one way or another. As a last resort, you can use that comp if you make a 10 to 20% discount on the ARV, just as a fallback. Especially if you're wholesaling, your buyers are going to be a little bit skeptical of putting value into a comp if it's on a busy street when yours is on a quiet cul-de-sac. Because let's just be honest, if you had a choice between living on a busy street or a quiet cul-de-sac, you'd probably go with the more quiet area. So just from a desirability perspective and a common sense perspective, you just have to go with what you really think feels right at the end of the day. So all in all, just because a comp might be close in proximity, maybe a quarter mile away, doesn't necessarily mean that it's a great comp. You have to understand that there are similar properties around it, like things can change again from block to block. So you have to factor in some of these other things that can skew your value one way or another. Just keep that in mind when you're looking at comps and do your best to find the most consistent, not just the house itself, but also the surrounding area and the overall curb appeal and desirability. All right, I like this. We're going deep on comps. What's the next question, Tim?
What if the property is unique and has no true comps?
Okay, if the property is unique and no comps. This actually reminds me of a property that I bought. It was 2017. This was a truly unique property that was just very large. So this is a good example of, I bought a property that was over 4,000 square feet, single family house with 10 bedrooms and 7 baths. So there were absolutely no other homes in the whole zip code in this area that were that big with that many beds and baths. The reason I bought it was because I know that it had value based on the income the property produced. I knew I could rent by the bedroom and pull $8,000 a month on this property. I knew that there was intrinsic value based on the net cash flow. To me, not having comps didn't matter as much because I knew what my end game was, and I knew that the value came from holding it long term and producing some very attractive cash flow. What happens in that case? I didn't necessarily need comps. What I did was kind of like what I mentioned before. I looked at the price per square foot of this property compared to other properties in the area that it sold. So much smaller properties, right? We're talking 2,000 square feet, 1,200 square feet, 1,800 square feet, just pretty much average houses in the area. We're selling for $350 a square foot, $400 a square foot, all the way up to $500 a square foot in some cases. This house I was able to get, I think, for around like $270 a square foot, maybe like $250 to $270, right around there. And so I knew that I was getting a very good deal just based on the dollar per square foot, because you can't build it for that cheap. You can't build that house for as cheap as I was able to buy it, considering the land cost as well. So I knew that I was baking in good value. I didn't necessarily need model match comps for my business model because I knew where the value was going to come from. The appraiser, when we actually bought the property, they actually had to pull comps from other zip codes like around town to find houses that were 9 bedrooms, 5 baths. I think that was the other largest house that they had found. So they were really pulling comps from other areas, and I didn't necessarily agree with their valuation. So it actually didn't appraise for the price that I bought it for. It appraised for $60,000 or $70,000, less than what I ended up buying it for. So unfortunately, we had to put up more money out of pocket to buy the property because it didn't appraise. So I had to cover that appraisal gap. Several years later, it was worth significantly more. Our investment is probably 3 or 4x in that property, and it's produced double-digit cash flow for me and my investors every single year since owning it. Ended up being an amazing investment. Kind of similar, if you're looking at other properties that are truly unique, you want to look at the price per square foot. And that's a little bit tricky, but you want to just make sure that you're getting a good deal based on what are other properties selling for by the square foot. It's tricky because the bigger the property is, right, the bigger the house is, usually the dollar per square foot number will go down. So you don't want to look at a 900 square foot house that just sold for $400 a square foot and say, hey, my 3,000 square foot house is also going to sell for $400 a square foot. You want to just find the closest comps possible, and there has to be comps. It might not be considered a comp from being as relevant as we normally would want it, but there has to be sales. There has to be sales data. So comps and determining the ARV is all about the data. So look at the data that's available to you. If there's no sales at all, then maybe you shouldn't buy there because there's no investment happening. There's no transactions happening. The only way I would buy in that situation is if I had a plan that's going to make me money. Right? If I knew I could buy the property for $500,000 and I knew I could rent out the property for $8,000 a month, I know that that's a good deal because my business plan allows me to make consistent returns from the cash flow, and it doesn't really matter what the comps are. But in other cases, if you don't have any comps, if your plan is especially to fix and flip a property, you absolutely need sales comps. You need data to support what your resale value is going to be. If there aren't any comps that model match your property or even similar, you just have to look at what's available. A lot of students ask, a lot of new investors ask me, there aren't any renovated comps in my area. Every other property is distressed or it's lived in. There's no renovation in the area, but I know that I can renovate this and sell for more. But I always recommend never break the comps. Never think that your property is going to sell for more than what everything else is selling for in the area. Yes, it's possible, but I'm not going to bet my money on that, right? I'm not going to take a huge swing that I can sell a property for 20% more than everything else that's sold in the area just because it looks nice. That's how you can lose a lot of money, and that's how you can get yourself in trouble on a deal because that's pure speculation. So you have to look at the data, and if you know that your property's, same in every aspect, but it's going to be a lot nicer than everything else, then you can conservatively say that you can pretty much hit the ceiling of what things are selling for, but you don't want to go beyond that. So you just kind of have to be conservative with your ARV. Don't think you're going to sell it for more than what everything else is selling for. You can at least use that to your advantage because if there aren't comps, then you can realistically justify an ARV that is at the ceiling of what the comps and the data tells you, and then work your way backwards. You still just have to work backwards from the numbers, factor in what the repairs are going to be, and then ultimately how much profit you want to make, your holding costs, and then what you can afford to offer to make it a good deal. Be conservative in those scenarios. If there aren't any comps, if it's a unique property, then, unless you have a clear business plan, you might just want to move on to the next deal that does have a clear exit strategy, that does have clear value tied to the end of the day once you're done with it. Again, that's why it's good to have coaching. It's why it's good to have mentors. It's good to have other deals in your market to look at as examples so that you can replicate that success, so that you're not trying to reinvent the wheel and try to be a pioneer in an area unless you really know what you're doing and can move forward with confidence. That's what I'd recommend. Be cautious in those scenarios. Sometimes you can make a deal a real winner, like the deal that I mentioned before. That turned out amazing, but I've had deals where it was pure speculation and I lost a lot of money on it. Just be careful when there's no comps and be very conservative. So hopefully that gave you some tools to analyze these kind of unique properties confidently, because we want to empower you to make smart decisions, resourceful, not reckless, and ultimately make good investment decisions. That was 5 questions. Tim, was that 5?
That was 5. Just one more. One just came in. What if I'm in a market that's changing quickly?
Okay, a bonus question. What if we're in a market that's changing quickly? Okay, how to find comps. We experienced that, the past few years. I think it was 2022, interest rates shot up at a rate that we've never seen before. That changed the market very quickly. We had kind of a peak pricing in most markets, and then things kind of softened, and in some markets actually went down to some extent. In those scenarios, if a market's going up or down, right, when the market's going up, that just gives you more confidence in your numbers and more confidence to be a little bit more aggressive in your business plan. Maybe you can tighten up your margins, and ultimately we still want to use the data that's there. We don't want to speculate. And all the flips that we've done and all the deals we analyze, we don't factor in appreciation, especially on a fix and flip. So if you're holding long term, sure, there's a case to be made to add some appreciation, but when you're fixing and flipping, you have to use the comps that are available today. No one knows what's in the future. So if the market's going up, then stick to the principles. Use the comps that we have today, because anything above that is just icing on the cake. You'd rather expect less and make a lot more than the other way around. You're expecting to make a killing, you work hard, and then you ultimately make a lot less. Better to be conservative and just use the numbers today and don't factor in appreciation. And on the flip side, if you're in a market like what we saw in 2022, in some areas where prices were dipping because interest rates were up, affordability was down, and it was harder to sell flips in some of these markets, then you just kind of have to reevaluate, and you kind of have to factor in a softer market. So that might mean paying attention to the trends. You want to be very, very careful in those markets. You're trying to kind of catch a falling knife. You don't want to do that. So factor in a 5-10% discount to your ARV depending on your hold time, right? You typically want to do projects that are shorter in length because the longer you hold a project in a market like that, less confident you're going to be in what you can ultimately sell it for. You want to discount the ARV if the market is not performing well. You're seeing days on market go up, you're seeing inventory go up. You just have to make sure that you're pricing your ARV more competitively than what you're seeing today. So maybe you will create an ARV at $500,000 today, but you know that interest rates are going up and the market's changing. Then you don't want to have your ARV be $500,000. You might want it to be $480,000. So you're actually baking in the expectation of selling for less than today. I would think that's somewhat common sense, but a lot of times when you're looking at deals, when you're trying to make things work, it will get very tempting to push the ARV, think it's going to sell more because you just want to get into a deal. That's how you can make mistakes. That's how you can lose money. So in those situations, just be extra careful. Talk to real estate agents, talk to investors, understand how other similar projects are going in the marketplace. Are deals selling fast? Are multiple offers happening? Are there many people attending the open houses? Or are there crickets? Is it empty open houses, no offers, days on market or 30 days plus? Those are signs that the market's softening and changing, and you just want to discount the ARV in those scenarios. And, again, if it's going up, just keep it the same. And if the market works in your favor, that's just icing on the cake. So that's a great question because real estate is a fluid market. It's dynamic. It's a lot slower than the stock market and other more efficient markets. So it does definitely move slower, but it's so important to adjust your expectations depending on where things are going. So just talk to people in your market, know where the puck is going so that you can make sure you're making good investment decisions and you can move forward with confidence. Those were the top 5 hacks about real estate comps taken directly from our weekly live coaching calls. If you want to learn more about what it takes to be in our Ultimate Investor program, where we help you build a 6 to 7 figure real estate investing business through our coaching tools and side-by-side help, then check out our program at realestateskills.com/programs. I'll leave the link in the description. See you on the other side.